Hello, beautiful people, and Happy New Year. It's 2024. I hope 2023 was good to you. Well, guys, it's that time of year again. My favorite time of year, tax season. Hello, my name is Shantae Hall. I am an enroll agent, and I am the owner of SHC Tax Solution. If you are returning to the channel, welcome back. Welcome back, family. If you're new to the channel, welcome as well. Before we get into the meat and potatoes of what I want to share with you guys, go ahead and subscribe. If you're not subscribed, go ahead and subscribe. Doesn't cost anything to subscribe. Just hit that button, turn on your post notifications so YouTube will let you know when I post new videos. Let's get right into it. Have you subscribed to the channel? Did you hit the like button? Keep in mind, this video covers tax updates that I felt were the most important. It doesn't cover every single tax update. I would be here talking to you guys for hours. Do you want that? You want to hear me talk for hours? Okay. So first thing first, let's talk about the increase in the standard deduction. For single taxpayers, the new standard deduction for the 2023 tax year will be $13,850. With an additional $1,850 if you're blind or over the age of 65. If you're married, filing joint, the new standard deduction for the 2023 tax season is $27,700 with an additional $1,500 if you're blind or over the age of 65. If you are married but you choose to file separately from your spouse, which you can do, the standard deduction is the same as single, $13,850 with an additional $1,500 if you're blind or over the age of 65. Head of household, the standard deduction is $20,800 with an additional $1,850 if you're blind or over the age of 65. If you're a surviving spouse with a qualified dependent, then the standard deduction is $27,700, the same as married filing joint, with an additional $1,500 if you're blind or over the age of 65. If you're the dependent of another taxpayer and you're still filing a separate tax return, then the standard deduction would be $1,250 or your earned income plus $400 with an additional $1,550 or $1,850 if you're single or head of household. So keep that in mind. I like to go over the standard deduction because those are important. It's going to tie into everything else that I'm going to share. I mentioned this during the tax update video last year. So obviously the standard deduction is much higher than what it used to be years ago. But keep this in mind, with the standard deduction being so high, most taxpayers wouldn't have a need to itemize their deductions. There are still, plenty of taxpayers that fall into that itemized deduction category, but the majority will take the standard deduction because the standard deduction is so high. So if all of your deductions does not exceed the standard deduction, there's no point in itemizing. We're going to see an increase in audits because, again, with this very generous standard deduction, if you're someone that you have lots of itemized deduction, you better be sure to keep all of your documentation to substantiate what you're deducting on your tax return. Now that we've discussed the standard deduction and itemizing, let's talk about the tax provisions that will be expiring. Tax rates have changed over the last few years, and they're going to change in the upcoming year as well. Also, as you guys noticed, last year, the child tax credit during the COVID years, the IRS was giving very, very generous deductions for a child tax credit. That is no longer. The child tax credit is the maximum refundable portion of the child tax credit is $1,600. The exemption for alternate minimum tax is also expiring. This is what you guys need to pay attention to. The standard deduction, I just went over the new standard deduction for the 2023 tax season, and they've gone up a little bit. But the standard deduction will be reverting back to the lower amounts, which will affect a lot of taxpayers. So keep that in mind. You'll definitely have to make some adjustments to your withholdings. If you're self-employed, that may mean you'll have to pay more in estimated tax payments. The PEAS limitation, which prevented high income taxpayers from decreasing their taxable income by claiming large and numerous itemized deduction. Again, if you're taking large deduction, this is something the IRS will be looking for, so that is going to be expiring as well. The discharge of student loans, that's going to be going away as well. Moving expense reimbursement, which is already limited for the current tax season as well the previous tax season, that is going to be expiring. I don't know if you guys remember the mortgage interest deduction. There was a change that limited the amount of mortgage interest that a taxpayer can deduct on their tax return, including their home equity. This will be expiring too, and these changes will be taking effect in the 2025, I believe, tax season. State and local limits. Right now, it's currently at $10,000. You're limited at $10,000 for deducting state or local income taxes. That is going to be expiring. The qualified business income, okay, that's a deduction that self-employed individuals are able to take on their personal tax return. That will be expiring. Increase in contribution limits. That is going to be expiring. Estate and gift tax exemption, that's going to be expiring as well. So that is a brief overview of some of the tax provisions that will be expiring or have already expired. Another provision that will be phasing out beginning with this tax season, 2023, is the bonus depreciation for businesses. I'm sure a lot of business owners, you guys remember this. It's a very generous deduction you can take. It allowed you previously to deduct up to 100% of a business asset. So with the change, it's going to be, instead of 100% of eligible business property, business can write off up to 80% instead, which is still quite generous. Okay, but just keep that in mind, and that will take effect this tax season. Now let's talk about what's happening at the IRS. Employee retention credit. If you're self-employed, you're probably very familiar with this credit. You probably were contacted by numerous firms telling you that they can give you a large sum of money back, but without giving you any detail. So the issue with that, the employee retention credit, is the IRS has stopped processing them, I believe as of September of last year, because they gave so much money to fraudulent businesses. Does that sound familiar? The same thing happened with those PPP loans and the EIDL loans. They gave so much money because what happens at the IRS, they will process first and ask questions later. So with these ERCs or employee retention credits, they gave so much money out to, in the billions, to fraudulent businesses, but by the time they figured out, oh man, wait a minute, we're giving money that are to businesses that are not even eligible for the credit to begin with. So what that does, it affects legitimate businesses. I have a few clients myself that have been waiting on their refund for, has it been a year? Almost a year, coming up on a year. And that's unfortunate. I have a feeling with the employee retention credit, supposedly the IRS, the last update that we receive is they will start processing those within the next few months, but they don't have a firm date. I just have a feeling that because they have issued so much money out, they're going to get to the point, just like the PPP loans, EIDL loans, where they're going to run out of funds if they haven't already. We're also seeing and will be seeing a large increase in audits. The IRS has, and they're still hiring, they have hired a lot of revenue agents. So the audits, they're coming. They are coming. Make sure that you can back up everything that you report on your tax return. As a tax preparer, I definitely ask the necessary questions. If there's a red flag, I don't do it. I don't do it. I'm a licensed enrolled agent, and I'm not willing to put my license at risk to get a taxpayer or client an additional few dollars. If you've called the IRS last year, summer last year or the end of last year, you know, you probably experienced a long wait, a long hold time. That has gotten better. That's improved quite significantly. And again, that's because the IRS did a mass hire and they're continuing to hire. So that will continue to get better. More assessments. We're going to see a lot more notices, CP 2000, paper audits coming. We are going to see a large number of assessments coming out because a lot of the provisions that were in place for the previous tax season are expiring. If you guys watched my tax update video last year, you'll remember that I did briefly discuss digital assets or cryptocurrency. The IRS will be asking for 1099 reporting from exchanges like Coinbase, Kraken, Gemini, etc. So before right now, there isn't a reporting requirement in place for cryptocurrency or digital assets, but surely they will. Now let's talk about the tax credits that have been revamped or expanded. The residential energy credit has been expanded, and I'll go into that a little bit more in a bit. The clean vehicle credit will now include a section for used vehicle. Previously, it was just for newly purchased vehicles. The investment credit has expanded from 3 pages to 10 pages. And the reason I'm mentioning that is because there are a lot of changes that is happening with the investment credit. Now let's talk about the new clean vehicle credit for vehicles that were purchased in 2022. The maximum amount of the credit is $7,500, and keep in mind that is non-refundable. So make sure you understand the difference between a refundable credit and non-refundable credit. Do you guys want me to make a short explaining the difference? Because I will. Anyway, so the vehicle has to be originally used in the United States. Of course, there is a maximum adjusted gross income limit. If you're married, filing a joint return, the maximum amount that you can earn is $300,000 to claim this credit. If you're a single taxpayer, the maximum amount you can earn to claim the credit is $100,000. Vehicles purchased before April 18, 2023 and after April 17, 2023 have different requirements. Documentation is required from the dealer. So if you purchase a solar vehicle or a hybrid vehicle, you should have gotten the documentation that states the specifications of that vehicle from the dealer when you made the purchase. For used clean vehicles or solar vehicles, the purchase price must not exceed $25,000. For used clean vehicles or solar vehicles, the purchase price must be $25,000 or less. The credit is 30% of the sales price with a max of $40,000. To qualify, the taxpayer must be the individual who purchased the vehicle, not the original owner, and the maximum adjusted gross income limit is $150,000 if you're married, filing joint, and $75,000 if you're a single taxpayer. There's also a clean vehicle credit for businesses. The credit amount is up to $40,000. So it's lesser of 15% of your cost basis or 30% for non-gas or diesel vehicles or the cost of the vehicle. This credit is also non-refundable, and your cost basis will be reduced by the amount of the credit. For business owner, there are some e-file requirement changes for W-2s, 1098s, 1099s, etc. So if you're an employer that files at least 10 W-2s, they must all be filed electronically. Employers must add their 1098 and 1099 form together to determine if they must be filed electronically. So obviously if you add them together and they equal 10 or more, then you must file them electronically. The good news is the IRS did release a new online portal to facilitate the compliance and to help businesses file those forms electronically. 1099Ks. I saw this coming a long time ago, by the way. If you're a business owner, you know what a 1099K is. It's basically if you use apps like Square, what's the other? Because I use Square. I'm trying to think. PayPal. any like app that process a payment processing app is what I'm trying to say. So if you use those apps, the reporting requirement for these will be changing very soon. So for 2023, this tax season, the old rule will still apply. A 1099-K will only be issued for transactions that reach up to $20,000 and 200 transactions, excuse me. But in 2024, this is going to catch a lot of business owners off guard and unprepared, I guarantee you. In 2024, the 1099-K reporting requirement will be changing, and that change is if transactions reach $5,000, not $20,000, $5,000 or more, a 1099-K must be issued, and there is no minimum transactions. That is going to affect a lot of business, and I think it's just a matter of time before the IRS figure out how to get reporting on bank accounts. The IRS's goal is to eventually get to $600 reporting threshold, which will have a lot of business in a chokehold if they're not prepared. And definitely expect more CP 2000 paper audits coming. You guys have probably already heard about the Corporate Transparency Act. I've gotten a lot of emails and calls regarding that. Basically, the Corporate Transparency Act is a new federal law that requires most domestic business entities to file reports with the Financial Crimes Enforcement Network that identify business owners. So basically, what this law does, it was designed to help prevent and combat money laundering, terrorist financing, and other financial crimes. If you're a business owner and you have not registered your business, please do so as soon as possible. I'll be sure to include the link to the website where you can do so. Required minimum distribution, there is a change coming to that. Currently the age is 73. Eventually the required minimum distribution age will be 75 for individuals who turn 74 after December 31st, 2032. Tax cuts and the Job Tax Act will end December 31st, 2025. Plan now. You have the information, you know it's coming. Plan right now. Higher tax rates for individuals going up. This really won't affect corporate rates. Those will stay reduced, but the individual tax rate, because remember during COVID, those tax rates went down. Those are going back up. The return of the personal exemption. I was surprised to hear this when I was at the meeting. Remember the IRS eliminated the personal exemption and increased the standard deduction. Well, the personal exemption is coming back. So that means what? The standard deduction will go back down. Personal exemption, and the personal exemption, it wasn't a huge amount, but that will come back and the standard deduction will reduce. And again, this is going to affect a lot, especially single taxpayers. So prepare and make sure that you have that W-4 adjusted to have the appropriate amount of taxes coming out. Mortgage interest will increase from $750,000 to $1 million, and plus the $100,000 for home equity interest. Miscellaneous deductions will return to over 2% of your adjusted gross income, because remember previously that was eliminated. Those were the tax changes and provisions that I felt were the most important that affects the common taxpayer. So that is it for this video, guys. Thank you so much for watching. Again, don't forget to like the video, subscribe to the channel, and leave a comment. Let me know what you thought about this video and what you would like to hear from this point going forward. If you found this information helpful, share it with anyone that you think can benefit from it. I appreciate you guys for watching. Have a blessed and safe 2024. Bye, guys.